Well, good morning and welcome to Financial Accounting. Today is the first full day of spring. If you missed that, yesterday was the first day of spring, but because it transitions during the day, today's the first full day of spring. So I decided to go with the spring colors. I'm done with winter colors. You won't see me wearing brown anymore because I'm just ready for spring weather. Happy to see it's sunny out already. It's going to be 54 degrees today. Hopefully you were able to enjoy some of the 70 degrees that we had over the weekend. As we look at our calendar then, we will be finishing up chapter 8 today. So we're going to be picking up with exercise 7 and chapter 8 in just a few minutes. So the chapter 8 exercises ideally will be submitted for grading by the end of the day today. And then maybe we'll start chapter 9 today, but definitely by Thursday. So the chapter 9 pre-quiz and the chapter 8 problem should be submitted for grading on Wednesday. I tried offering the drop-in review session last Friday morning, and we did not have a lot of takers for that. So I'm going to try a different day and time of day for this week. I'll be scheduling that later today. I'll get it on the calendar. I'll put it in the announcement. And if anyone is interested in that, it's not like an extra class, but it is a optional 1 hour set aside specifically for financial accounting. So if you have questions, if you wanted to be going over something, if you just think you need more practice with a particular chapter or whatever, that's what that time is for. It's really up to you, anyone who chooses to attend, what we would go over. So if you would like to attend, once I put that date and time out, if you would like to attend, please just go into Starfish and go into the courses area. Under my name, under this course, you'll see a link for you to sign up for that review session. So please go ahead and do that if you want to attend. And then if there's something specific you want to go over, send me an email and say, you know, I was kind of hoping we could do some extra practice on chapter 8. Or whatever, and I can prepare for it that way. It might mean putting together a couple exercises for us to work on. And if the review session happens and there's content that can be shared, I will be recording those. The one thing I would not put on recordings is anything related to exams. So if there's something you want to go over from an exam, that we could do that in a review session, but I would not include that on the recording. All right. Friday, remember I mentioned last week in class, Friday is the business program reviews, and some of you may have received an email from me inviting you to be a part of the student kind of a focus group for a half-hour Friday morning. I would appreciate if you could just check your email. If you have an email from me about that, just reply, say yes or no. If you can't or aren't interested, that's fine. Just let me know. And if you did not receive an email, but you think you have something to contribute, I would welcome your participation. The reason I didn't invite more people specifically from financial accounting is because for many of you, it's your first semester. And so I don't know how much input you'll have at this point about the business programs. So I am not at all trying to cut off any participation if there's someone who thinks you have something to contribute. The point of those program reviews is to set the path for the business programs at JCC for the next 5 years. We do these program reviews every 5 years. And so, you have a chance to contribute to the robustness of the program. And I would encourage you to let me know if you would like to participate. It's Friday morning. I believe it's 10:30 to 11. It might be 10 to 10:30. I think it's 10:30 to 11. So just send me a note and let me know if you want to participate. But if I specifically invited you, please let me know one way or the other so I can update my list. What will happen is you'll come in, it's a Zoom connection, you would come into the Zoom room. I will be there to introduce you to the visiting team, and then I will be leaving, so anything you have to say would be confidential in that the team will share with us their overall impressions, what the information they got from the students, but I wouldn't know specifically who said what. So it, your personal identity is protected, I guess, but what you have to say is not. That's the whole point of the review, is that we hear from all of these groups what we could do better, or what we could do differently, what we might want to consider. All right, so let's get started then with chapter 8, where we left off on Wednesday of last week, unless anyone has any questions or anything you want to mention, talk about. Okay. So, excuse me, I need to spend just a couple minutes because I realized as I was looking for a specific exercise this morning that the exercise, the content that I was looking for is not in any of the exercises. So that's an oversight, a mistake on my part, that there is no exercise that covers exactly what I was looking for. So it occurred to me after class on Wednesday, I was thinking, well, next class we're talking about notes receivable, but there's one piece left of the accounts receivable allowance method that we haven't talked about yet. And I remember specifically saying, we will talk about this, and then it's not in the exercises. So we're, as we frequently do, I'm going to talk about what this would look like outside the context of the exercises and adding on to what's here. So I'm going to use the information in this exercise just because it was the last one we did. And we'll go from there. So this is the exercise where we ended class on Wednesday. And we had calculated that their uncollectible, what their net income would have been if they used the allowance method would have been $693,700. And we went through what that would look like and what the journal entry would look like to record that allowance method. But I just want to remind you of that. If I can get my annotate tools up here. So what we had calculated was if they estimated that 1% of their sales, and their sales were $6,740,000, let me get my actual calculator. I need to use my cell phone calculator when I have a perfectly good calculator right here. And actually, now that I'm looking at what I typed on the screen, we definitely don't need a calculator for that at all. So 1%, we just need to move the decimal place a couple places. Oh. Okay, so just a review of what we covered last week when we talked about using the allowance method. So the idea of uncollectible accounts and an allowance method for recording that is the matching principle tells us we record revenues when we've earned them according to that test that we've talked about. We have a price that's fixed or determinable. We have an agreement between the buyer and the seller. We've delivered the product or performed the service, and we have reasonable assurance of collectability. That last one, the reasonable assurance of collectability, means for any given customer, if we allow them to buy on credit, we believe that they will pay us. But we also recognize when we sell to someone on credit that we are taking a risk that some of our customers will be unwilling or unable to pay us when that invoice comes due. And so, again, according to the matching principle, we record those revenues, but we need to match against those revenues the expected costs, regardless of when they take place. Some of those costs may not be in this current period, And that definitely applies to the concept of uncollectible accounts. Rarely would we know in the same month that the sale took place that our customer is not going to be able to pay us or is going to be unwilling to pay us. So the matching principle says that's fine. You can still sell on credit. You can still record those revenues, but you need to estimate an amount that you think is not going to be collectible. And last week we learned two different ways of doing that. One was focused on the income statement. That's what we have here in this exercise, that they looked at their sales for the period and said, we think probably 1% of those are not going to be collectible. And so that's what we did in this exercise. Use that sales, the income statement approach or the net sales approach. The other method that we looked at was the balance sheet approach or the AR aging method, where we look at how much is actually owed to us, when were those invoices due or when will they be due, and assign percentages to each one of those classes or categories on the aging, and come up with a number that we think is going to be uncollectible of all of the amount that's due to us. And that's how much we're going to put into that allowance account. Regardless of which method you choose to use, and either one is perfectly acceptable. As we said last week, the two methods have the same goal in mind, which is to be realistic about how much of our sales we're going to be able to collect, how much of our credit sales. The focus is just different. One's on the income statement and one's on the balance sheet, and that's fine. At the end of the day, what happens is we do an entry that looks like this, and I use the term uncollectible accounts expense. Doubtful accounts is another reasonable term to use. The book also uses bad debt expense, and that's fine too. Just abbreviating a little bit there. And so at the end of the period, regardless of which method we're going to use, whether we're focusing on the income statement or the balance sheet, we do an adjusting entry that looks like what I have here on the screen now. It's a debit to the expense, so we're matching those expenses against the current revenues on the income statement. And then on the balance sheet, we're setting aside this allowance. And that allowance is being set aside so that in the future, when we actually do need to write off accounts, we have a place to write them off. That's the part that is unfortunately missing from the exercises that I chose here for this chapter. And so that's what I need to show you now. What does it look like when we actually write off an account? So for this company, this was their first year of operations. And so when they do this adjusting entry, they have, I'm just going to put a T account on here for the allowance. Allowance. Abbreviate for uncollectible accounts. Okay. And the entry that we just did here, we credited the allowance account for the amount we think is not going to be collectible in the future. Any questions about what I just reviewed? Everything that we did here is information from this exercise and the concepts that we talked about at the beginning of the chapter last week. Is everyone okay with what we've done so far? Okay. So we talked about that on our balance sheet then, the allowance account is a contra asset account. It goes against the asset. It has a normal credit balance. And on our balance sheet, when you see something that says accounts receivable net, it means that we have subtracted this allowance. The allowance account has a normal credit balance. We said it could, on occasion, have a debit balance. It shouldn't. Okay, it's not what you want. It's not the situation we're looking for, but it could be, in particular, at the end of the period before we do this adjusting entry, we could end up with a debit balance. And I told you last week that I would explain when we got to this point, explain how that could happen. How would you end up with a debit balance in this account? So as we look at this, we've done the adjusting entry, and at this point, we're assuming, excuse me, we're assuming that Max Plumbing Supply, the company in this exercise, has not yet written off any accounts. Their first year of operations, they may have some customers that are delinquent in payment. They're getting to the point where they're saying, I don't know, maybe this customer's not going to pay us. We've sent some letters. Maybe we've threatened to send them to collections. Maybe we've actually sent them to collections, and the collection agency that we hired is not being able to collect from those delinquent customers. And so what happens now? At the end of the year, you can see right here in the first sentence of the exercise, it tells us during that year, they actually wrote off $48,600 of accounts. They estimated, using the allowance method, they estimated they would need to, at some point now or in the future, write off a total of $67,400, but they didn't have to write all of those off yet. They're still holding out hope that some of those customers will actually pay their bills. So when we use the allowance method, this is how we write off an account. And I'm going to show you how this company, Max Plumbing Supply, would write off this $48,600 if they are using the allowance method. If they use the direct charge-off method, which we know is not acceptable under GAAP, if they use the direct charge-off method, it would look like this. Whoops. The amount was $48,600. And then the credit would be to accounts receivable. So if they use the direct charge-off method, they would not have the entry like we have it here for recording the allowance, because they're not using an allowance. They would not have that entry at all. Instead, at the time that they write off the accounts, the entry would look like this: a debit to the expense and a credit to accounts receivable. We remove those accounts from accounts receivable because we've recognized those customers are unwilling or unable to pay for whatever reason. So we don't want to continue to show that they owe us the money because we've recognized they're not going to pay. And at that point, we report the expense. So the issue is, if we report the expense at that time, it may not match up against the revenues from the same time period, right? These accounts that we're writing off could have been from a different time period altogether. I know this is a first year for this company, but that's not a typical situation. So how would it look different? If we were using the allowance method, we would not record the expense at the same time we recorded the write-off. The expense would be recorded in the period that we reported the revenues. And instead, change the color here. Instead, the write-off would look like this. The write-off would be to the allowance rather than to the expense. We have this adjusting entry where we estimate the expense. And then when we write off an account, we write it off to the allowance account. In other words, we're going to debit the allowance account. We set aside that value in the allowance account using the adjusting entry, and then when we actually have a write-off, we lower the amount in that allowance account. Okay, so the direct charge-off method, you'd only have this one entry. When you use the allowance account, you have the adjusting entry to set aside that allowance, and then you have this entry for writing off an actual account. Does this make sense? So after we write that account off, what you'll notice is the balance in the allowance account goes down. So what's our new balance in this account? 67,400 minus 48,600. The new balance in this account would be $18,800. That's how much we have left that we think we're still going to need to write off in the future. So, last point, and then we'll move on. I had told you, and I reviewed at the beginning of this class, that this allowance account is a contra asset and its normal balance is a credit balance, but it could have a debit balance. So what would make this account have a debit balance? If this number, the 48,000, where we have the 48,600, if that number was higher than the 67,400. For example, if instead of writing off only $48,600 worth of accounts, what if we had to write off $70,000 worth of accounts? We had only put aside 67,400 and we had to write off more than that. That would give us a debit balance in the allowance when we wrote off more than we planned, wrote off more than we had estimated we would. And that's how you would get a debit balance in this allowance account. It's not ideal. It's not what should happen. What it might indicate is that we didn't do a very good job of estimating, or maybe something changed. Remember, we said those estimates are based on our history, so what's happened in the past, but it also takes into account any current events. And so think about what's happening in our economy right now. Do you think that there are more companies now that are unable to pay their bills than there were, say, 2 years ago? And the answer to that, I think, is a pretty clear yes. And so if our estimates are based on what was happening last year, and we didn't take into account what's happening right now, we could end up with not enough allowance set aside. And so how do we fix that? Well, if we use the balance sheet approach, we fix it because remember when we did the exercises using the balance sheet approach, we had to see, well, what's in the allowance now? How much do we need to add to it to get to that targeted ending balance? When we use, as we did in this exercise, when we use just the percent of sales approach, when we use the income statement approach, we don't ever look at the balance sheet to see, ooh, well, how did we do last time? Do we need to fix that? Do we need to adjust that a little bit? Everything is focused on the income statement. So that's what I needed to cover that was not in our exercises. How do we actually write off an account? And that's this piece right here. A debit to the allowance. It reduces the remaining balance that we think is going to be uncollectible, and a credit to the receivable to remove that specific customer's receivable that we don't think is ever going to be collected. Any questions on that before we move on?
I have a question.
Yeah.
So if they, after you do that journal entry and they pay it, how would you do that?
Yeah, that's a really good question. And we are actually going to see that in one of our exercises that we have left to cover when we talk about notes receivable. So if you can just hold on to that question as we go through the next few exercises, and then if I'll try to remember to ask you once we get through that, but if I don't and you still have a question, just ask again, okay?
All right.
But I think we're going to answer your question as we go through the next exercises. Because yeah, that does happen sometime, right? We think that a customer is not going to be able to pay us, and maybe we've been as patient as we can. Maybe we have a policy that uncollectible accounts are written off after they're 6 months past due or whatever. And with that policy, it may be that we wrote off an account and we just were a little too quick. And so a customer that had not been paying, was delinquent, was way behind on paying bills, maybe then turns things around and is able to make good on that debt. And so, yes, we will see in one of these exercises how we do that. That's a great situation to be in, right? We thought you weren't going to pay, but you did, so thank you. we'll see what to do with that. Any other questions before we move on? Okay, so I'm gonna go to our PowerPoint just for a couple minutes. I want to do a quick comparison between the direct write-off and the allowance methods, and then we're going to move into notes receivable. So with the direct write-off method, we only record the expense when we write off a specific customer's account. We don't use an allowance account at all. The direct write-off method, as I mentioned, is not acceptable under GAAP unless you're a company that just doesn't deal with receivables. But it is, the direct write-off method is what's used for tax accounting purposes as well. The allowance method is going to be used by large companies, companies with lots of receivables that are publicly traded. It's a good practice to use an allowance method even if you're not publicly traded, but if you're not publicly traded, GAAP doesn't apply to your accounting because you aren't reporting to the external sources in the same way. The allowance method allows either one of those approaches to be used, so you should be familiar with both of those and how to implement them and calculate them. And we're going to move on then to notes receivable. So notes receivable, I already mentioned the formal term is a promissory note, and it is a debt that normally is going to include interest on that debt. And so as we work through these next exercises, we're going to be looking at how do we calculate the due date, how much interest is owed on that promissory note, and when is it, and how much would we pay in total when the note comes due? Because in this chapter, we are talking about notes receivable. We are the lender, or what's known as the payee of the note. The maker of the note is the borrower. The maker of the note is the one who is going to pay the note back. In an upcoming chapter, then we will, as we talk about liabilities, we'll talk briefly about the payable side of it. But as we've said in earlier chapters, if someone's borrowing, someone else is lending, right? So we're going to see both sides of that transaction between the receivable chapter when we're the one lending and the liabilities chapter when we talk about it from the borrower side. Again, the borrower is referred to as the maker of the note. So as I said, promissory notes, one of the main differences between notes and accounts receivable is the inclusion of interest. And typically a note receivable is going to have a longer horizon, a longer time period or maturity length before it's due. I've used most of these terms already. The maker of the note is the borrower, the one who's making the promise to repay. The payee is the lender, the entity that's going to receive that payment along with interest. The face amount is the principal, the amount that's being borrowed. The issuance date is the date the note is issued or signed. That's the date that the clock starts ticking. The due date or maturity date is when the note is going to be repaid, and in our exercises, we're going to be calculating what those dates would be. The term of the note is the duration or the maturity length, how long from the time the note is issued until it has to be repaid. And then the interest rate is usually expressed as an annual interest rate. That's the reward or the payment that is being paid for the privilege of borrowing the money. This is an example of what a formal promissory note would need to include, and this is what it might look like. So all of those things that we just went through must be included there To have a valid promissory note, we need to know how much is being borrowed, when it's due, what the interest rate is, who's making the promise to pay, who is the receiver or the payee on that note. So you can see all of that information here. Okay. So with that in mind, let's go to our first new exercise for today, and that is exercise 7. In exercise 7, we have two things that we need to figure out for each one of these notes. We have 5 separate notes, lettered A through E. They are telling us to assume that this is in a leap year, so February has 29 days. Remember, we already talked about in an earlier class the importance of knowing how many days there are in a month, and if you do not know, please consult a calendar, because otherwise it will make you get the answer wrong, and it will have nothing to do with whether you understand the accounting and everything to do with whether you know what is included on a calendar. So please check if you're unsure. For each one of these notes, then A through E, we're going to calculate the due date and the amount of interest that would be collectible on that note. So we'll start with the due date. We don't need any special calculations or formulas for finding the due date. On January 5th, a note is made or signed or issued with a duration or term of 120 days. So let me get my tool back up here. So January has 31 days, but we're not going to count the first 5. So we start counting on January 6th. The easiest way to do that then is to take the total number of days in the month and subtract the number that we're not counting. Okay, so 31 days in January, but we're not going to count the first 5. So we've already have in January, we have 26 days. We're told to assume that assume that it's a leap year, and so February has 29 days. Then March has 31 days. So I'm now up to 86 days. We're getting closer, but we're not quite there yet. So that's March. April has 30 days. And so now I'm up to 116 days. I need 4 more. So this is January, February, March, April. I need 4 more days to get to the 120 that is the term of the note. So if it's January, February, March, April, May, then the due date on that note would be May 4th. May 4th. May the 4th. Everybody okay with how we calculated that? Okay, let's try the next one together. So this one's a little easier for us because the term is only 30 days. So we start with February. The date the note was made was February 15th. It was issued on the 15th. So we're not going to count the first 15 days. So we have 14 days in February. To get up to the 30 days, then we need 16 more days in March. And so the due date on that note would be March 16th. Any questions about those at this point? Okay. I'm going to pause the recording and ask you to do the calculations for the next 3 notes, just for their due dates. When you have those due dates, and feel free to use the check my work if you want to. Once you have those due dates, we'll restart the recording and then we'll talk about how to calculate the interest. Okay, so I showed my calculations there on the screen. I got July 3rd, November 18th, and January 17th for the due dates for those remaining 3 promissory notes. Anybody with questions about those? Okay, I'm going to erase my screen then, and then we can talk about calculating interest. So in order to calculate interest, we need a formula. I'm going to put the formula on the screen here. Oops. Interest equals principal times rate. Save space here, times time. So that is the general formula for simple interest. And the abbreviated formula to help you remember, I equals PRT. Where the rate and time have the same terms, the same duration. So if the rate is the interest rate, and as I already mentioned, the interest rates that we are given are annual rates. So that's the interest for the year. But none of the terms of the notes are in years, they're all in days. And so we need to convert the number of days into the portion of a year. And you'll notice we are told right here in this last sentence, assume 360 days in a year when computing interest. So it used to be that banks used a 360-day year. I don't mean to say that their years only had 360 days, but they used 360 in their calculations. I don't know that that's true anymore. It does simplify things a bit. It actually helps out the bank when they use that calculation. But for our purposes in class, we will be told in all of our calculations to use 360 days. As I said, I don't know that that's common practice with banks any longer, but it definitely used to be. So here's our formula, I equals PRT. Let's see how we are going to use that. So for our first note, the face amount, the principal, is $90,000. The amount that's being borrowed or lent is $90,000. So we're going to be paying interest on that full principal at 6%, but that's 6% for a year, and we're not borrowing it for a year. We're only borrowing it for 120 days out of the 360 days in a year. So this is how we convert the time in days into portion of a year. Take whatever days and divide by 360. If we were using a standard year, 365, you would just divide by 365. So let's do that calculation. 90,000 is the principal that we're borrowing, or sorry, we're the receivable and we're lending $90,000 at 6% for 120 days. When I do that calculation, the interest I got was $1,800. So the maturity value of this note, when the note comes due on May 4th, we expect the maker of the note, the borrower, to pay us the $90,000 that they borrowed plus the $1,800 in interest. We expect to receive $91,800 when that note matures on May 4th. Everyone okay with that calculation? Try one more together. The note that was made on February 15th was for $21,000. The interest rate on that was 4%, and that was just for 30 days. So again, we need to change those days into years or portion of a year. So 21,000 times 4% times 30 divided by 360. And I got $70 for that. So why is that $70 so much less than the $1,800? Well, there are three different factors involved here. How much you borrow, what the interest rate is, and how long you're borrowing it. The more you borrow, of course, the more interest. The higher interest rate, of course, the higher interest. The longer you borrow it for, the more interest you will pay. Any questions about using this simple interest formula? When we get to chapter 11, in case you're wondering, why is she saying simple interest? I'm not saying the formula is simple. I'm saying that this is a formula for simple interest. When we get to chapter 11 in a few weeks now, we will talk about compound interest, where you pay interest on the interest. In this case, we're only paying interest on the principal or the amount that we borrow. But in chapter 11, we will learn how to calculate if we're paying interest on the interest or receiving interest on the interest. If there aren't any questions, I'm going to pause the recording again and ask you to do the remaining 3 calculations and then restart the recording. Again, you can use the check my work button before you restart if you want. So we have our interest calculations here, each one of them, principal, the amount we're being borrowing or lending, the interest rate that we agreed to, that's an annual interest rate, and then the percentage of the year, portion of the year. As I mentioned last week when I first did a brief introduction on notes receivable, one of the differences between accounts and notes receivable is accounts receivable are almost always, almost 100% of the time, they're going to be current assets for us, that our customers are going to be expected to pay their bill within 1 year. Notes receivable can be more long-term. And so all of these are short-term. They're less than 1 year in duration, but a note could be a year or 2 or 3 years down the road before it comes due. And for those long-term notes like that would be considered, rather than a current asset, they would be considered an investment for us as the lender. Let me get my green check marks in there. I probably should have done that already to make sure I didn't have any math errors in there or a calculator error, which I tend to do. If there aren't any questions, we'll keep going. I'll erase my screen. And move on. Okay, so the first part of this exercise is going to be review of what we just did in the previous exercise, determining the due date. So please do that. The note was made on April 20th or issued on April 20th, and it's a 120-day note. So how are we going to calculate that? 30 days in April, plus May, plus June, gets us to 71 days. So then we'll add July, and that gets us to 102 days of the 120-day note. So we need 18 more days. 120 minus 102 is 18. So that's how we get to the 120 days. April, May, June, July, August. The due date on that note would be August 18th. Okay. Everybody good with that? The next part, I use the term maturity value. We know that the maturity value of the note is going to be the principal or the face value, the amount that we're borrowing or lending in this case, plus the interest. So we'll use that simple interest formula to find the interest first. So I equals PRT, whoops, not the right letters, PRT. So the principal is the face value, the amount that's being borrowed or lent. The interest rate we agreed to was 6%. And the time was 120 days out of the 360-day year that we're asked to assume. And so the interest alone on the note is $1,600. So on August 18th, when Bork Furniture, we are Bork Furniture Company, we are the payee on the note. Valley Designs is the borrower or the maker of the note. And on August 18th, Valley Designs should be paying Bork Furniture the total amount that's due. That's the $80,000 that they borrowed plus the $1,600 in interest. So the maturity value of that note would be $81,600. All right. So why would Bork Furniture Company, now presumably Bork Furniture Company is in the business of selling furniture. Certainly sounds like it. Why are they now in the business of lending money, which is essentially what's happening? Why did they tell Valley Designs, go ahead and make us or issue us a note for $80,000 at 6% interest with a due date 120 days from now? Why would they do that? Well, one of the reasons that it may happen is because maybe Bork had sold to Valley Designs on credit. Maybe the terms were net 30, just throwing something out there. And during that 30-day grace period, before Valley Designs account became due, they realized, ooh, we didn't get paid what we were supposed to get paid, so now we don't have the money to pay our supplier, Bork Furniture. And so maybe they reached out to Bork Furniture and said, you know, we can't pay that bill when it's due. Could we issue a promissory note to get an extension on that payment? We'll pay you interest to compensate you because we're not going to pay that invoice on time. So that's one very reasonable explanation for why this might be happening. Valley Designs is a customer that was unable to pay their regular account when it came due. Or maybe even at the time they were buying $80,000 worth of whatever it is, furniture that they're buying, they said, we're going to need some extra time to pay. Our normal terms are maybe net 30, but in this case, we aren't going to be able to pay in 30 days. Can we just extend that normal time period, that normal grace period? And again, we'll pay you interest to compensate you for the use of your money for an extra 120 days. Either way, there needs to be an agreement between Valley Designs and Bork Furniture. I think the way it says this, the receipt of the note might make you think, well, Valley Designs just did this on their own. They just sent Bork Furniture the note and Bork said, oh, look at this. I guess they're not paying their bill on time. And they've decided the 6% and 120 days. That's not how it would work. It would definitely be an agreement between Bork and Valley Designs that this is what's acceptable. There might be some negotiation on the interest rate or the time period, for example. But what we're asked to do here is to assume that the note is being made, and because it says on account, we are making the assumption, because of that phrase on account, we are going to make the assumption that the reason Valley Designs is doing this is because they already have a bill with Bork Furniture that they need an extension to be able to pay it. And so what we're doing is reclassifying the $80,000 that Valley Designs already owes Bork Furniture. We're moving it out of accounts receivable and into notes receivable. So we're simply reclassifying it. They're both current assets for us, accounts receivable and notes receivable when the note is 120 days. These are both current assets for us. We move it out of accounts receivable into notes receivable to recognize that it's going to come with interest. We want it off our, if you think about what we did last Wednesday, otherwise this $80,000 would continue to show up in our accounts receivable aging, and we'd be thinking, hey, why haven't they paid us? That was past due, and we might be following up with them rather than when we do this, we move it out of accounts receivable, it's off our aging, it's no longer part of that computation. And we recognize, oh yeah, we've given them an extension, we've given them an extra 120 days to pay their bill. I know sometimes in class it sounds like I'm just speculating or guessing, like when I said, we're going to assume what this means is that it was already in accounts receivable and we're going to move it into notes receivable. I just want to reassure you that if we worked for this company, it wouldn't be quite so, fly seat of your pants. Gee, I guess maybe this is what it meant. We have just a limited amount of information here in our exercise, and sometimes we have to make some assumptions about what they meant by that. But if you work for the company, if you didn't know, you would just ask, because there'd be somebody there in the company you could ask, hey, what's this all about? Why did Valley Designs issue this note to us for $80,000? Oh yeah, they owed us $80,000 in accounts receivable and we're just giving them an extension. Everybody good so far? This all making sense? Okay. So we've already calculated that the note itself will come due on August 18th. And the assumption here is that on August 18th or before, on August 18th, Valley Designs pays what they owe. And that's what we're asked to journalize here. Valley Designs is paying their bill. So in part B, we already calculated how much do they owe us. Well, they owe us the $80,000 that they already owed us in accounts receivable, plus the $1,600 in interest at 6% for 120 days. So we're assuming they pay us the full amount. Now here in C1, we set up this note receivable to show that Valley Designs owes us $80,000 on that note. But now that they're paying it, we need to get that off our books. They don't owe us that anymore. So we're going to credit notes receivable to get rid of that, to clear it off our books so that we aren't thinking, hey, Valley Design still owes us $80,000. Why haven't they paid? And then as always, our debits and credits need to be equal. So we need a $1,600 credit to make these the two sides balance, to make this entry balance. What is that $1,600? Where have we seen that number before? What is that? It's our interest, yeah. It's the interest we earned by allowing Valley Designs an extra 120 days. And so it's going to be interest revenue or interest income. I actually prefer the term interest income because revenue, I tend to think of revenue as being something we receive from our customers when we sell them product or service, whatever it is we're in business to do. This interest income came about not through our normal course of operations, but because we allowed an extension on this amount that was due to us. But either way, it'll show up on the income statement. It will increase our net income, our bottom line for this accounting period. So any questions about that? So we now know how to calculate due dates, interest, maturity value, how to record the receipt of that note, and then the payment of the note. Everybody good so far? Okay, let's keep going. Exercise 9 says entries for notes receivable, including year-end entries. And so the new part in this exercise is going to be what happens here on December 31st, when our customer, Unitarian Clothing Company, Clothing and Bags Company, has a note that they issued on December 7th for 60 days. So if we fast forward 60 days from early December, it's going to be early February. If we are using a calendar year as our fiscal year, we're going to close our books at the end of December. But Unitarian's not going to pay what they owe us until February, if they pay at all. And so at the end of December, we're going to need an adjusting entry to recognize that, hey, we've earned some interest on that note, even though the customer, Unitarian Clothing, is not going to pay us until February. We've earned it. We've met the 4-step test that the SEC has for us to know if we've earned that income or that revenue. And so we're going to need to calculate that and then record it so it shows up on our books at the end of the year. And that's what's going to be different or new about this exercise. I think I can just about, not quite fit everything on there. Okay. On December 7th, 2017, we received from Unitarian Clothing and Bags Company on account. So again, we're going to assume that this is was an accounts receivable that they are reclassifying as a note receivable. So the note was for $75,000 due in 60 days, and 3% interest will be included on that. So when we receive the note, we move it out of accounts receivable into notes receivable, right? We've seen that in the previous exercise. Now the note was made on December 7th and it's not going to be paid until February 5th, we can see right here. So at December 31st, when we're closing our books, we need to calculate how much interest has accrued already. How much interest do they owe us already? How much interest have we earned? And so at the end of December, we're going to use that same formula, I equals PRT. But at the end of December, how much time has passed? So interest equals the principal, the face value of the note is $75,000. The interest rate is 3%. But how many days have passed since December 7th? There are 31 days in December. We're not going to count the first 7. And so that leaves 24 days left. And we're going to use that 360 days in a year. So at the end of December, interest has accrued for 24 days. And I got interest of $150. Is that what other people got? So I know this entry is going to be for $150. What exactly is it? Well, they now owe us that interest. So I'm going to call it interest receivable. I don't add it to the note receivable because that's for the face value. And just like we saw in the last exercise, we're going to record that as interest revenue so it shows up on our income statement. So it increases our income for that period. Make sense so far? It then asks us to record the closing entry for that interest revenue. And this is review from a few chapters ago now, that to close our temporary accounts, which includes our revenues, expenses, and dividends, we're going to just zero them out. So the interest revenue has a $150 credit balance. To zero that out, we need to debit that account $150. That income adds to our net income and gets moved to retained earnings when we close our books. So this is just one tiny piece of the whole closing entry that the company would be doing at the end of the year to close out all of their temporary accounts. The reason they have this entry here is just to remind you that that interest revenue is being recorded in the period in which it's earned and gets added to our income, added to our retained earnings in that period, even though the bill isn't due, the note isn't due from Unitarian until February. We've still earned that revenue, that interest in December, and it needs to be recorded in December and added to our income. All right. Any questions so far? The last thing we're asked to do for this exercise is to record the receipt of the note with interest. So Unitarian is paying their full bill, the full amount that they owe us. So I need to recalculate the total interest. So we've already calculated interest just for 24 days, but the full note is for 60 days. So let's see what the full or total amount of interest would be at 3% for 60 days. So for the 60 days, I found that the interest due would be $375. Everyone okay with that? Okay. So this is going to look a little bit different though, this entry, than what we did in the previous exercise when they paid the note, because we've already accrued part of that interest, remember. Part of the interest income or interest revenue was shown in last year's books. The cash, we realized the maturity value is the principal of $75,000 plus all of the interest. They paid the full amount that they owed. Because they have now paid that, we need to get the note receivable off our books. They no longer owe us that $75,000 that we set up back here on December 7th. They don't owe us that anymore, so we need to get that off our balance sheet. What else? On December 31st, we recorded a receivable of interest of $150. Do they still owe that, or did they just pay it? They just paid it, right? So we need to get that interest receivable off our books as well. They don't owe us that anymore. They already paid it. Now we can tell, because we have a template conveniently with all the correct number of lines, we can tell how much must go here in order to make this entry balance. We need 225 more. Oops. We need $225 more to make this entry balance, to make the debits and credits be equal. So what is that other $225? It's the interest for January 1st through February 5th. We already recorded 24 days of interest. This is the other 36 days of interest. Any questions about that? So we've now seen how to calculate due dates, maturity value, interest, simple interest, how to accrue interest at the end of a fiscal period. Any questions? All right, well, I'll move on to our final exercise. And this is where we're going to address that question that Michaela asked after exercise 6. Our first two entries here are receiving 2 separate notes, 2 different customers that were moving an account receivable over to a note receivable because they're not going to be able to pay their bills on time. We're asked to journalize the following transactions in the accounts of Missouri Gaming Company, which operates a riverboat casino. When we started this chapter last week, we were pointing out that the concerns about receivables and uncollectible accounts vary greatly from industry to industry. Our very first exercise looked at a casino in Las Vegas compared to Johnson & Johnson. And we saw that their expectations about collecting on receivables might be very, very different between those 2 companies, or 2 types of companies, 2 different industries. And so we already had that discussion that when you are maybe operating a riverboat casino, that you have more of a concern that some of your customers who you allow to buy their services, their casino services on credit, you have more concerns that some of those customers may not pay. And that's what we're going to see here. What do we do when the customers don't actually pay? And then at the end, we'll see what happens when a customer we thought wasn't going to pay actually does pay. How do we handle that? And this will be our final exercise for this chapter. On March 29th, we received a $30,000 60-day 5% note dated March 29th from Carrie Platt. And it's on account. And so we already said the assumption, what they mean by that is that we are moving what was an account receivable over to a note receivable with an extended time to pay and interest included. And we're going to do that same thing on April 30th for a note from John Kelly on account. Everybody good with those? It's the 3rd and 4th time we've done that kind of an entry. So the 60-day note from Carrie Platt, 60 days from March 29th would be May 28th. And on May 28th, then we should have been collecting $30,000 plus interest from Carrie Platt. But what does it tell us? The note is dishonored. So when we honor the note, it means we pay it. We pay it off. We pay the note, the face value plus the interest. When this tells us that Carrie dishonored the note, it means he or she did not pay. So what do we do with that? Well, the legal document that was signed, that promissory note, said that Carrie would pay interest for 60 days. So at the end of the 60 days, we have no more expectation, no more legal expectation that if the note gets paid, it's going to include interest beyond those 60 days. We know that we are now owed the interest for the 60 days, but that's all we can expect. And so I need to calculate the interest for those 60 days. So we're going to use that same simple interest formula. Principal times interest rate times time, and we're still using the 360-day year. And I got $250. So at the end of May, when that note comes due from Carrie, Carrie should have paid $30,250. And so what we are going to do, since the note was dishonored, the note matured, we need to move it out of notes receivable. $30,000. We need to move it out of notes receivable, and we're going to move it back into accounts receivable because the note already expired. It matured, it hit its due date. But Carrie no longer owes us just $30,000 because Carrie signed the note that said he would pay $30,000 plus $250 in interest, plus the 5% interest for 60 days. So now Carrie owes us $30,250, and we still get to claim that interest income. We've earned it, even though we're a little suspicious at this point that Carrie's actually going to pay it. If during that same time period, it became clear to us that Carrie was not going to pay the note at all, we would not move it back to accounts receivable. We would instead write off that account, and we would write that off by, just like we saw at the very beginning of class today, we would write that off by debiting the allowance account. We wouldn't move it back to accounts receivable. We would write it off if we had more reason to believe that it was never going to be collectible. Maybe we learned that Carrie was in bankruptcy or something like that. And so we would write that off by debiting accounts receivable, and the credits would look just the same here. Did I just say debiting accounts receivable? If that's what I said, that's not what I meant. I meant debiting the allowance account if we were writing it off. But we're still holding out hope here that Carrie is going to actually pay the note. And so we move the full amount that's due to us back into accounts receivable. And we're going to do the same thing for John Kelly, who also dishonored his note. And so at the end of June, when that note comes due, we're going to move that along with its corresponding interest back to accounts receivable. So go ahead and do that calculation. Calculate the interest on John's note. Question for you. Why do you think it is that, what's the name of this company? Missouri Gaming Company agreed to the 5% note for Carrie Platt, and 1 month later agreed to an 8% note from John Kelly? Why do you think those interest rates are so different? That's a huge difference. Why do you think that is?
This is the first time they've taken money.
Okay, so that could be a good reason. In the classroom, it was suggested maybe this isn't the first time they've taken notes from John Kelly and from Carrie Platt. Ultimately, there's one reason for a difference, but not a difference of this magnitude. One reason for the difference could be because interest rates in general have changed. But to change by 60%, because it went from 5 to 8%, that's an increase of 60% on the interest rate in 1 month is unheard of. That's not going to happen. It is more likely then, as was suggested here in the classroom, that they have a level of perceived risk associated with this, and they think John Kelly's more risky. They think that he is less likely to pay his bill. And so in order to accept that risk, they want to be compensated for it by charging him a higher interest rate. And that's probably what it is. Okay, so what happened now? On August 26th, Carrie Platt paid the note, and Carrie included interest for the next 90 days. So, my bad, I know it was due back in May. I couldn't pay it in May, but now I'm going to compensate you for that additional 90 days. I'm still going to pay you interest, even though I didn't even have a note signed that said I would. I'm gonna do the right thing. I'm going to pay you interest for the full 90 days at 8%. So that's 8% on the total amount that was due now. So remember, as of May 28th, Carrie now owed not just the $30,000 from the original note, but the $30,000 plus the 5%. And shoring up what we just suggested might be the reason between the difference between the 5 and the 8%. When Carrie pays the bill, she's going to pay it at that higher interest rate. So I'm going to calculate the next 90 days worth of interest on the full amount that was due at that time. So now it's still a simple interest calculation. And I got 605 for that. It's still a simple interest calculation. However, it is actually, he or she is paying interest on the interest at this point. So this $250 right here is interest, and Carrie's now paying interest on not just the principal, but also that original interest that was accrued. So good for Carrie. Carrie's going to make good on what he owes or she owes. And so the cash that Missouri Gaming is going to receive is the $30,250 that was already owed in accounts receivable, plus $605 more in interest since the note was dishonored. So we'll no longer have that receivable from Carrie, and we get to record some additional interest revenue or interest income of $605 at that time. Now, honestly, we would have been happy if Carrie just paid the $30,250, right? A little extra bonus, a little extra revenue for us that we reached an agreement where, where Carrie paid the extra 8% for the extra 3 months. Okay. Any questions at this point? Now, this is actually what I was looking for that I was not finding when I was trying before class this morning to find where do we do an actual write-off. I couldn't find it, but I'm glad to know I wasn't totally mistaken, that we do have an entry here to write off an account. On October 22nd, we said, you know what? John's not going to be able to pay that note for whatever reason. I don't know what's going on with John, but we have no expectation of being able to collect on that note, and so we're just going to write it off. And this is what I went over with you at the beginning of class before we started our first new exercise. When we write off an account, the debit is to the allowance rather than expense. Remember, we've already estimated at the time those sales were being generated, we already estimated a total amount that we didn't think would be collectible. But when we actually write off the account, and the account has in it right here, $24,320. When we actually write off that account, we write it off by debiting the allowance rather than an expense account. And we credit accounts receivable. Yeah, John did owe us $24,320, but we have no hope of collecting on that. It's not appropriate then to continue to carry it on our books as a receivable if we have no expectation of ever receiving it. Now, any questions about that? So that's the end of this exercise, but I want to do one more thing here that I think will help to answer Michaela's question from earlier. But does anyone have a question at this point? Okay. So Michaela asked, so what if after we write off this account, John comes back and says, wait, I want to pay my bill. Some other casino let me come gamble there and, you know, I now have enough money to pay you off. What is that going to look like? So let me show you what that would look like. The first thing we would do is restore the account receivable. So if John comes to us and says, hey, I'm going to pay the $24,320. I would basically reverse this entry from October 22nd. So I'm going to just say this happened on November 1st, just making that up. So on November 1st, John comes to us and says, I want to pay my bill. Or let's say I want to make a payment on my bill and I'm going to pay off the amount I owe in 3 monthly installments. Just throwing that out there as one suggestion. So what do? We take the entry from October 22nd, my brother's birthday, and we reverse it. We flip it, so where we debited before, now we're going to credit and vice versa to get rid of that write-off. We're going to undo it. And so the debit is going to be to accounts receivable for John Kelly, because on October 22nd, we credited that account. And the credit is going to be to the allowance. We had used up part of that allowance, but now we're going to put it back. We don't need that anymore. Okay. We're going to put that back and we'll have it available when someone else has a write-off. And then let's say that John made his first payment. And I'm just going to round off and say he paid us $8,000. And so we're going to show that we now have that cash of $8,000 and reduce the remaining accounts receivable. So now it shows he owes us only $16,320. If he had paid the full amount, the entry on November 1st, the second entry I have here, would have simply been a debit to cash for the full amount, $24,320, and a credit to accounts receivable for $24,320. So the first thing we need to do is restore the account receivable so that we have a place that shows, hey, he owes us that money, and then we can show that we collected it. I know it seems a little bit inefficient to do 2 entries. Why don't we just show the cash collection and a credit to the allowance? Because we need this trail of what happened there. Where did that cash come from? Oh, it was John Kelly's account. Michaela, does that answer your question from earlier?
Yes, it does. Thank you.
Okay. Yeah, you're welcome. And certainly this does happen. Unfortunately, sometimes we do have to write off accounts. And fortunately, sometimes we write off accounts and later on the account is still made good. That can happen. We hope that the first one of those, writing off accounts, is fairly infrequent. And when it does happen, we certainly hope that eventually those accounts are made good. But the idea is we want our financial statements to be as accurate and fairly representative as possible. And so if we have a strong reason to believe that John Kelly isn't going to pay his account, for whatever reason, and we talked about last week what some of those reasons might be. Maybe there's a bankruptcy proceeding going on. Maybe the customer can't be found, can't be located, has moved out of the area. We don't know where he is. Has stopped responding to our letters. In this case, gave us a note receivable and then didn't honor the note. All of those are reasons for us to believe that John's not going to pay us. We don't even know where he is. And he's ignoring our efforts to collect. So unfortunately, that does happen. As we said, that is a consequence. It is one of the risks that you accept when you decide to sell on credit. You recognize that some of your customers may not pay. In reality, we know that if we don't allow credit at all, we're going to lose some sales. If our credit policy is too tight, too restrictive, we're going to lose some sales. If our credit policy is too loose, we're going to have more of this kind of stuff, more of our customers where we took a risk not being able to pay their bill. Each company then needs to decide what's the appropriate level of risk that they're willing to take. And it runs the gamut from some companies saying, we don't extend credit at all, and then we don't have to deal with that, to other companies saying, like the example I gave you last week, it's not uncommon for small local car dealerships to sell to people who have bad credit or no credit. They charge a higher rate of interest. I'm not saying whether that's ethical or unethical, but they charge a higher rate of interest to be compensated for the risk that they're willing to take. And so it is just up to the business to decide what level of risk are we willing to accept and how are we going to accommodate that risk. Are we going to charge higher rates of interest than someone, if you could go to your bank and get a car loan, you're going to get a much lower interest rate than if you go to one of those types of car dealers. Okay. That is the end of the chapter, and as I figured would probably be the case when I thought maybe there'll be extra time at the end, we really don't have any extra time. We have just 4 minutes left in our regular class time. So we'll stop here for today. On Wednesday then, we will start chapter 9. Any questions before we call it a day? All right, well, thank you for being here. Enjoy the first full day of spring. Hopefully I'll see you all on Wednesday.